Welcome back to Market Matters, your guide to understanding the Indian stock market. Once a company decides to go public, it appoints experts to handle the IPO, called merchant bankers, also known as book-running lead managers. Their job? Ensure legal and financial due diligence, prepare the draft red herring prospectus, DRHP, market the IPO through roadshows, help decide the IPO price range, underwrite the issue if it doesn't get fully subscribed. So what exactly happens in an IPO? Let's break it down. Company appoints merchant bankers, SEBI registration. The company files for approval, explaining its business and finances. Approval and DRHP filing. This document is shared publicly for investor awareness. Road shows and advertising. The company promotes itself to potential investors. Price band is fixed, say 100 rupees to 120 rupees. Book building opens. Investors place bids within the range. Final price is decided based on demand. Listing day. Shares are available for trading in the stock market. Once the IPO is complete and shares are listed, the company enters what's called the secondary market. Here, anyone can buy or sell shares on stock exchanges like NSE or BSE. Prices now move based on demand, supply, and investor sentiment, just like any other stock. Before we wrap up, here are some key IPO terms every investor should know. Under-subscription. Not enough people want the IPO. Bad sign. Oversubscription. Huge demand. For example, 3 times more bids than available shares. Green shoe option. Allows issuing extra shares if the demand is high. Price band. The minimum and maximum price range offered during the IPO. Cutoff price. Final price at which shares are allotted. So that's everything you need to know about what happens during an IPO. In the next episode, we'll dive into the secondary market, where most of the daily stock market action happens. Don't forget to like, subscribe, and share Market Matters for more insights.